Hello, everyone, and welcome to my monthly update on alternative asset fund administrator and audit league tables. There are over 600 fund administrators and 500 audit firms servicing the private markets. I am George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Note that our alternative asset league tables are only available and made available to Convergence clients. League tables can be purchased at the Convergence e-commerce site, which is convergenceinc.com. I will be providing some commentary today on the movement we saw in the market from July 2020 to July 2021. I'll also be joined this month by two Convergence clients, Jeremy Neilson, who is the CEO of Assure Fund Services, and Sal Shah, who is a financial services partner at BKD. Both Convergence clients and both firms with noteworthy performance over the last year. Today we are with the co-founder of Assure Fund Services, Jeremy Neilson, from the great state of Utah. Good day, Jeremy. Welcome to our podcast this month.
Thank you. I'm thrilled to be here.
Yeah, well, it's great to have you. We've been very impressed with your firm and with the growth of that firm. So generally, Jeremy, what we're doing each month is we're obviously talking about administrator growth, and then we do get into some topics with each of our leaders. And we have a few questions that we wanted to kind of put out there to you this month. And again, we're appreciative of you taking some time to chat with us today. I want to start with some of the very topical investment strategies in the market, right? SPVs, ESG, crypto, cannabis, et cetera. And clearly, we know the great brand you've developed around the SPV market, and we'd love to hear about that journey and how you've built that brand and how you've built that business. And probably secondly on that front, love to discuss kind of what your firm is doing relative to targeting these markets, and how do you really differentiate Assure from the other 600 plus administrators in the market?
Yeah, that'd be great. So a little background on myself. I went to law school, got an MBA. In addition to that, worked at a university venture fund as a student where we got the chance to talk with professionals. It was very fun to help do some due diligence and assist them as they make investments. From there, I was hired to launch and run the state of Utah's Utah Fund of Funds. It was a $300 million program. We spent our time evaluating funds, and we spent our time talking to startup founders who wanted to get access to those funds. So I spent 7 years doing that, kind of a little bit of a mini VC firm and a fund of funds at the same time as I tried to facilitate introductions and investments for the state of Utah. After I left there, I launched Assure, not really in the same format that it is today. I had lots of failures for a number of months as I tried to iterate. But when I left the Utah Fund of Funds, one thing was very clear to me, and that was that the market was changing. The entrances into the market that wanted to invest in private assets, the family office at high net worth, they were a little bit different than maybe the very, very large family offices, the very, very large the pension funds, the endowments. They were different, and they were a little bit frustrated with their access into traditional large venture capital private equity firms. There was a little edge to them where they're like, I really want to be a little closer. I didn't want to write a blind pool check and then pay fees and then get a return in 5, 10, 15 years. And so I was really starting to see some movement in the market in these LPs that wanted something a little different. I call that kind of a structuring change, and kind of filed that in the back of my head as I was building Assure with my co-founder. We one day got a call from AngelList, and the Jobs Act had come, had passed. The SEC had given some no action letters, some issued some rules, and all of a sudden there was this opportunity to fundraise from people in a different way through kind of a platform. And AngelList was like, hey, can you figure out how to do funds in bulk? And I said yes, because I'm the ever optimist idea person. Took that yes to my co-founder, who then turned around and figured out how we could actually make it happen on operations side. But we turned around and created the Assure SPV, which allows you to do basically a fund in bulk at speed, at cost, transparently. And from there, it kind of took off. Not kindly, it really did. Our phone started to ring longer and more frequently. So we built the engine that AngelList built their platform on, where we could do these SPVs. Our second phone call was Seed Invest, and then it just kind of snowballed from there. And so what we've really provided to the industry is an affordable, structured vehicle with all the administration needs bolted on top. Flat fee, one time. This is, you pay this once, and this is all the things that you get. Very different from maybe a traditional fund administrator, which is a monthly check to provide these additional services. And there's big reasons that we can pull that off, is because it's a single asset SPV rather than a multi-asset traditional venture capital fund that does need monthly services, where single asset SPV doesn't.
Yeah, I mean, listen, the whole topic of scale is really the topic. Well, do you have a view, Jeremy, just on, is that model portable to some of these other topical investment strategies like ESG or crypto or cannabis, digital trading, digital assets? Do you have a view on the ability for the administrators to take some of maybe what they could learn from you and scale those type of vehicles?
Yeah, at Assure, we provide services, single asset, multi-asset, SPV services for every asset class that you can imagine. We do startups, secondaries, real estate, crypto, cannabis, ESG, film, art, raw land, farmland, you name it. If it's a private asset and you need to wrap a structure around it, we provide a service for that. The thing that we see that there is a issue with seeing the scale with regards to crypto and cannabis is the banking system. So when the crypto and cannabis first got started, the banks were not yet up on it. So at Assure, we did a very robust business on crypto and cannabis. I would say that probably in 2018, 30% of all of our SPVs were crypto related transactions. The banks kind of caught up. They're like, we don't really like this for whatever reason. And they started to shut down, banking options. We got blackballed basically by a very large bank because some of our deals were crypto, and we always, we answer all the bank's questions. We're like, what do you need to know? Here you go. What information can we provide for you? So it was never us hiding anything from them. It was them catching up to the industry and the market. Cannabis was the same thing. And so today at Assure, we do help clients invest in crypto, cannabis, and others. It's very difficult to get bank accounts open for transactions that go into those assets. So, for us, SPVs is a ubiquitous structure for any asset. When we run into problems, it's not because of us, it's because of a third party, like regulatory or banking issues.
Yeah, well said. I actually just read recently the post you put out there on LinkedIn on farmland, which I thought was interesting to see. One of the things we're seeing, Jeremy, in the market too is, and I'm interested in your perspective, is additional service offerings, right? So what we're clearly seeing, when we started Convergence in 2013, there were 400 administrators, and today there's almost 650. And even though we see lots of acquisitions and consolidation, there's still a lot of firms kind of hanging a shingle out there. One of the things we're seeing as a big trend in fund administration is firms adding additional service offerings to the core fund admin. So whether it's tax or managed IT or cyber or compliance or outsourced CFO, COO, CCO businesses. Curious on two fronts. What are you seeing in the market? And then Secondly, what, if anything, you can share with us might Assure be exploring right now?
Yeah, so Assure is quite different than many of the other fund administrators. So there's kind of that full spectrum of private asset investing. You have very large fund of funds, venture capital funds, private equity funds, hedge funds. We live really much further down that scale with regards to much smaller checks, faster moving investments, a very different kind of mindset. And so what we had to do for Assure is we had to bundle everything together. So where some of these larger fund administrators are now starting to add services, we did that from the very beginning.
Yeah.
So we added basically legal or onboarding. So when someone says, hey, we're going to do a deal, traditionally fund administrators would have their client go to a law firm, say, go get your docs, get your regulatory filings, have someone help you do the fundraising, onboarding, review legal docs, all those things, maybe have them do your Form Ds and blue sky filing. Once you get all the way down the path to you're doing deals, that's when we step in. But at Assure, we step in at entity creation, EIN, bank account, documents, onboarding. We built technology to assist with this. We do the purchase agreement assistance. We wire those funds. We do the security filings. We always have had tax from day one. We do all that post-close activity stuff. We do dissolutions, M&A, IPO. We do all of it so that we could package it into that flat fee one time. You get all of this, pay up front type situation. And so we're seeing others kind of more or less mimic what we did in that. And I think the real issue here, or the marketing here, is that people want a one-stop shop more than they want these different places to go to. And we have seen that that's what they want. And so our clients have constantly come to us and said, can you add this? Can you do this? Can you, build this so that we can come to one place? So things that we've added over time that we didn't have on day one is KYC AML checks. When the 506C verification type offering availability came out from the SEC, we added the option that our team would do the 506C verification. And we also added ERA compliance filings for our clients. So where we're going forward for us and the offerings that we're building for our client are more on the technology side. How do we give them a easier, smoother, quicker, more transparent option? And frankly, even going even further, really leaning in, saying, how do we help them do it themselves? Either the computer does it for them, just click some buttons, or that how do they can basically be their own administrator using the system. That's really where we're seeing the market wants, kind of goes from, I want help, I want one-stop shop. And then we're seeing that people are leaning and saying, how can I do this? I don't want to wait for you. You're too slow. I don't want, I want to do it on my own timeline. And so we're seeing clients saying, can you build things so that I can just click the buttons rather than you click the buttons? That's what we're building.
It makes great sense, the end to end, because I think, clearly the advisor doesn't want, tries to cut back on vendors. And I think that's, a huge advantage you have, especially over some of the largest out there, and just kind of the nimbleness, of your model. All right, I wanted to shift to growth in the market, right? So we've been watching at Convergence really closed-end growth over the last three or 4 years, right? So real estate, PE, VC, structured asset funds, really significantly outpacing kind of hedge funds, right? Although while hedge funds are rebounding in terms of assets, it's not because there's more funds, it's people putting more money in existing funds. So when we look at our private database these days, the SEC registered advisors, there's probably 100,000 private funds, and about 85,000 of them are closed end. So just curious on your thoughts on open and closed, and how that's shaping kind of your efforts and Jeremy, your focus in the marketplace these days.
Yeah. I'm seeing similar things. I'm seeing this real shift in those with money. It could be institutions, family offices, high net worth, but also just simple accredited investors. Anybody that is permitted through the accreditation rules to invest in private assets, we're seeing a sea change of them wanting to get access. I think we could have possibly predicted it over time, where the education, the interest, the desire to get the returns from private assets has been growing over time. And so what I'm seeing on our side is that the interest to get a piece of private asset investing in someone's portfolio has grown and grown to the day till today. A lot of people are really hungry for it. And what Assure has done is allowed for smaller check sizes, right? Traditionally, you go to a large private equity firm, a fund, a VC, PE, real estate, hedge fund, they're going to have minimums. Right? There's certain seats that the only certain number of seats the SEC allows them. So if I'm going to raise 500 million, I can only have so many people invest. Therefore, I can only, my minimums need to be X. Those minimums are large, 100,000, million, 5 million, 10 million. The Utah Fund of Funds, we had to beg to get into a fund where the minimum was $10 million, and we did 7.5. As somebody that, personally, if I wrote a personal check, I'm going to want to write $1,000 check, not a $7.5 million check. I can't write a $7.5 million check. And so there's a huge group of accredited investors all over that are interested in adding private assets to their portfolio. And today they can now get in for 5K, 10K, 25K rather than 5 million, 10 million, 25 million. And that is opening up this opportunity that then kind of flywheels on itself of education and interest. And they tell somebody who then is interested. And so there's a very large sea change in that growth. So that growth then allows for more interest, more funds, more administrators that need to service them. And so I think it's really this eagerness to get private assets into portfolios, in addition to things like Assure has done to provide a change in the structuring and admin costs, the minimums coming down. All those things, the SEC, federal government, all those things helped and assisted in those things.
Yeah, I mean, it's really all about, better access, right? I mean, it's really, and more access, right? All right. Lastly, we just wanted to get your thoughts, Jeremy, on kind of the competitive landscape out there. What you're seeing in the market, and here, I'll take all this with a little grain of salt. All right, we don't want you to give all the secret sauce away here, but what are you seeing in the market, and what are the kinds of things as a co-founder that kind of keep you up at night these days?
Competitive landscape for us is I think it's really around technology. Anyone that wants to build technology around fund administration, because that's where we think it's going. At Assure, we really spent our early years figuring it out, what I call longhand. Doing it longhand, faxing into Delaware, filing taxes, doing financials on Excel, and then, upgrading and understanding everything, all the customization, all the preferences that come from clients, attorneys, other fund administrators. And now, we've started to build technology around all of those learnings. I believe that the market is moving towards groups, LPs, GPs, everybody wanting to be a lot more nimble on their phones, doing as much as they can by themselves on them, for themselves. And so any group that's going to tackle fund administration through technology, which I think is quite difficult, right? It's not easy to automate taxes. It's not easy to automate financials. It's not easy to automate, distributions. There's so many there's so many elements of regulatory and rules and expertise in there. I don't personally believe that all of it will be automated, but I do believe that there can be benefits, improvements, enhancements across the fund administration spectrum. And so that's who we track and wonder about. Again, Assure lives in a very different world than someone that's helping $100 million fund of funds or a $10 billion private equity fund. I find that completely different than the world that we live in. However, I will say that as us little guys, if you will, I mean, we're quite large when it comes to the number of deals. We're second or third in number of entities that are being managed. But there's differences between a single asset SPV and a $10 billion fund of funds. There is, and there's expertise that is different. So I think what you're seeing and what we're seeing is almost this fund administration spectrum is no longer just one group. It's really starting to see bifurcation and change where it's like, these guys are very different than these gals and these guys and these gals. I mean, they're different, and we know it and feel it very much. So, we know everything, we've seen everything, but our business is not to provide the type of services that others provide to a very, very large hedge fund. We're really about the fast moving, automated, single asset SPV marketplace rather than some other fund administrators out there.
Yeah, I think that's really well said, because we spend an awful lot of time Convergence with advisors around what we would kind of call best fit service providers, right? So really go to the firms that service the kind of business you have and have a book that looks like that and have clients that look like that. And so we, and I think you're right. Everybody in the market, even there's 600 plus, there's a lot of different approaches to the market, and a lot of people, if you break and decompose their books, right, of business, a lot of people have very different client bases, and they're good at some things and they're not good at others. So the best fit is a good way of looking at it, really empirically, right? Like what kind of business does this administrator do, right? And how's that business been built, and what does it look like over time? So listen, I want to thank you very much for joining us, and we greatly appreciate the time you spent with us, and we really wish you guys just continued success. It's been great to watch you kind of appear in the big leagues on this SPV front, and been fun to watch. So thank you, and congratulations.
Yeah, well, thank you. Thank you for having me.
I'm delighted to have Sal Shah join us. Sal is a partner at BKD. And he is with the asset management services practice and really runs the East region. So welcome, Sal. We're very happy to have you join us today.
Thank you, George. Appreciate you reaching out and letting us talk through what we are seeing and give our thoughts on some of the key industry topics here.
Well, we're delighted, and we've been impressed with your organization and your growth and focus in the market. So what I want to do, Sal, is just talk about a few topics that I consider, interesting to our listeners. And let me start with, some of these very topical investment strategies, SPVs, ESG, crypto, cannabis, digital assets. I'd like to understand a bit about what your firm is doing relative to servicing and targeting these markets. And then maybe secondly, what do you guys do to kind of differentiate BKD from, the other 500 audit firms in the marketplace? So interested in your thoughts on that, Sal.
Sure. Thanks, George. So let's go item by item here. First, you said SPV, special purpose vehicles. Use of SPVs is nothing new. Typically these days, when you say SPVs, it's also looked at, as a means of where in a investment in a pool investment vehicle, an investor is banking on the discretion or investment decisions made by the investment manager. In an SPV structure, an investor generally knows specific asset, single asset, or specific class of assets that they're going to be investing into. That's one differentiation. Now, the valuation issues that you look at are no different in an SPV versus in a pool investment vehicle. It is, again, as I said, very much more strategic. And our approach, to auditing, SPVs is no different than auditing a fund. Generally speaking, every entity has its own unique features. In this forum is not to get into details of that. Let me pick on ESG. ESG is more on sustainable environment funds concept, and we are seeing a lot of that. We've recently hired a couple of very high-profile people and building a small army here on ESG, because we are seeing a lot of potential and importance of ESG. If you look at PCAOB and in SEC regulations, especially around 40 Act, the specific requirements for disclosures now relating to those ESG disclosures, though gaining popularity, still maybe a bit of a lip service, but the future is definitely in sustainable investing.
Yep, agree. We agree with that, by the way. How about things like crypto, cannabis?
Yeah, so crypto, we are definitely auditing crypto. Again, we have built in a team of experts internally on crypto, and we're getting a lot of traction with crypto funds. And also, many of our banks and institutions are looking to transact in crypto as well. So that expertise, along with the blockchain expertise, is important. So when we are looking at a crypto fund, custody is one of the primary source of attention, besides valuation. So we look to see if the clients are following ISO standards and also cryptocurrency security standards as well, which is also commonly known as CCSS. So as long as client is following some of those, and we tend to discuss with clients and prospects as to what those are, we generally, believe crypto is the future here. Cannabis is the next item that you mentioned. So cannabis is an industry that's not federally legalized yet. Many states, as you know, have gone forward and legalized the use of recreational and medical cannabis here. So we as a firm are closely monitoring it. There's limitations because of not being federally legalized as to how cannabis industry, just not in a fund structure. They could be a manufacturing entity, they could be a distribution entity, etc. So we're closely monitoring it. We are not yet jumping into providing assurance and other services to cannabis funds yet.
Yeah, a little to your point, Sal, a little different, right, than the others we talked about. But clearly SPV, ESG, crypto, big part of I'm sure your growth agenda, right? That makes some sense.
Absolutely. And
Yeah.
just want to add one more point here, George.
Yeah.
That on the SPV side, SPACs are very popular. So our firm is doing a ton of consulting work relating to helping SPACs prepare themselves for reporting requirements here. We are not yet auditing SPACs ourselves.
Yeah, no, well, I think that's a great point. So thank you. I wanted to move to, the whole topic of additional service offerings, right? We're starting to see firms adding more and more, arrows to the quiver, right? And looking sometimes beyond that classic audit model of assurance, tax and consulting. Interested in what you're seeing, Sal, and maybe without giving away the secret sauce, things maybe your firm might be exploring.
Yeah, sure. So, I mean, obviously, any firm, a firm like BKD, which is national firm, we do look at different new services. We're constantly on the lookout. But I'll touch base on three specific offerings that we are gearing towards. One is ESG, we talked about. So, reporting around those and how to be prepared for those, that's a expertise that we are equipped to offer to clients, and we're seeing increased demand for those, and trying to stay ahead of the curve on the ESG as well. Yep. These days, with the internet, violations of security, cybersecurity is in high demand. We've had that service for a long time, but we're just seeing just an acceleration in the need for our cybersecurity services from our clients, and more inquiries coming in from prospects. The third service that I'll tell you that we as a firm are focusing on is the portfolio data analytics. So, there's so much data out there, how to make it more useful for the client. So our IT group have different applications and understandings. They can make all that data very much more meaningful for the client. On the private equity side, during pandemic, it became more obvious, where portfolio company information that might be kept and in processed, by different softwares at each of the portfolio companies, but the management information decision is being made at the PEG level, which is the parent company, right? So how to sync some and all of that information so that it's more meaningful for a private equity venture capital group to make some informed decisions. So that's another IT services that our firm is very equipped to provide, and seeing a lot of demand for it.
Yeah, no, I think that's well said, and those are really, I think, some add-ons that this market continues to look for. One side note I'd make, Sal, is, we continue to see when we talk about the league tables that when you get past the big four, and their growth, that the growth is much greater, down, from number 5 on in the audit market, and we continue to see that trend. We continue to see advisors, moving their business to, sometimes in their eyes, more nimble providers. So all those things can be, I think, continue to fuel that trend we're seeing. Let me move to the growth we're seeing in the industry, and certainly not telling you anything you don't know, but clearly closed-end fund growth over the last 3 years has been very significant. I think in the SEC registered market, there today are about 100,000 private funds, and almost 85,000 of them are closed end, and about 15,000 of them are hedge. However, we've seen just in this last year, hedge funds rebounding, but not necessarily in terms of new funds, but more money going into existing funds. So the growth rate that we see in hedge is on the AUM is 10, 12, 13% higher, but certainly down in new funds. Curious your views at BKD about closed versus open, and kind of how this shapes your efforts and your focus in the marketplace.
Yeah, so I'll answer it. This question, it's a great question. Private equity venture capital, which are typically the closed-end funds, because investors are committed, and they get their money back when the underlying investments are sold. So that's why it's a closed-end fund. And they've been popular. They continue to be popular in terms of an investment strategy. Um, I think the pendulum is it has swung all the way towards the closed-end funds. Um, then the hedge funds, who have an established track record, some of the larger institutionalized funds, they continue to get more and more investments. The new capital, and the more money you have, it's easy to make more money from existing money for your investors. The emerging managers, I think the pendulum is starting to swing. I just last I can tell you year and a half, we've had some new fund launches, hedge fund launches that become our clients. They started small, 5 to 10 million assets in the management. There are a couple of big stories. I'd say big because they're meaningful in this environment. They're almost close to 100 to 200 million assets under management. Right this morning, as we're recording, I had a call with an overseas fund manager, and he had a great story to tell as well. They launched one fund and they got a lot of traction. They thought they would be 5 to 10, but they exceeded 50 million. Now they're looking to launch the second one, and they heard a lot about us, BKD, and how we help, and how we actually work, partners in provide unmatched client service. A little bit of selling on my side, but that's a fact. So
Yeah,
he's
yeah.
looking to launch a $200 million fund, and we were having that conversation. Now, there's another trend here, George. They are hybrid funds, in the sense it's a hedge fund structure with maybe sub-series or side pockets where private equity type investments are housed, but obviously investors are locked in there until those exits are made. The difference is that a private equity manager who is a traditional private equity manager, they tend to be very close to the operations of a private investment, where they look to season those investments. And many times they have controlling interest of it. And then they look to exit those investments once the seasoning is done at a higher value for the investors. What hedge fund managers generally tend to do is they do get into private funds, but with a different twist to it, where they most of the times don't tend to take control, because that's not their bread and butter, their expertise. They tend to co-invest with other large interest holders in those private funds, or many times it's a matter of taking some of these private companies out of bankruptcy. So if you take a debt investment or equity investment at a lower value, and you come out at a higher equity or debt value than what you entered into after restructuring. So that's the strategy that hedge funds are using. That's what we assume.
Yeah, I think your point about hybrid is a good one. And what's interesting about that to me is, that's where audit firms and admins, fund administrators, really are differentiating themselves. If they're known only in the hedge world, or if they're known only in the PE world, when you get things like these hybrids, it tends to impact the choices advisors are making. And I'm sure you're seeing a little bit of that too out in the market.
Yeah, absolutely. And obviously people do tend to specialize, because some of the elements in a serving a private equity, it is very different than serving a hedge fund. And traditionally, the hedge fund, fund managers, may not understand or be fully equipped from a technology reporting perspective to manage both. But as and also traditionally, the private equity venture capital funds don't have as many trades. And as I said, investors are locked in, right? So those had been traditionally, the record keeping had been in-house. But there's a growing trend now where even the private equity funds are being outsourced. So more fund admins are coming up with a team that is serving both private equity and venture, private equity and hedge funds. Sometimes there's separation of teams within. From our perspective, BKD perspective, and I've lived in this industry, and all our professionals have lived in this, and I've been in this industry for over 25 years. So I understand all of it, and I serve anything that's investment company, irrespective of hedge or private, open or closed-ended funds.
Yep. All right. Last question, Sal, and I've been very appreciative of your thoughtfulness here. Let's just talk a little bit about the competitive landscape. It's busy out there. As I mentioned, there's over 500 audit firms named in SEC filings. What are you seeing in the market, and maybe what are some of the things that lastly kind of keep you up at night? What do you think about? What do you worry about?
Yeah, so nothing keeps me up at night. I sleep well. I'll be honest with you. That is because when I'm awake, I work hard, and we as a team are out there in the marketplace, right? And we're close to our clients in the centers of influences in the industry. We have representation. One of our partners is on the AICPA investment companies expert panel. So we out there working hard. So, but in competitive landscape, absolutely, there's so much competition in which is a good thing. Keeps everybody honest. We learn from each other, right? I know, all my competitors, and they call me, I call them. Sal, what are you seeing? But when it comes to, getting in front of a client, that's where the competition starts. And that's important. Bringing in new business, that's my focus for the firm. I represent the firm from a growth perspective, and it's challenging. Fees can be an issue, but the clients and the prospect want to know a few things. One is, your name brand, that's important. So we as a firm have 99 years of history, as a firm, PCOB registered, inspected, that matters to, prospects, that they are partnering with someone who has a long history, and they will be there for them, and the reports that we opine on has value, and we make sure we stand by our professional reports. As far as fees are concerned, we try to, we're not the most expensive, and we will not compete with the lowest of low, shop there. We try to price right for our clients. For emerging managers, we have an emerging managers platform where we understand what they're going through. They need hand-holding. So we provide all that, and making connections for them. And for some of the larger funds, are tending to notice that, they end up paying a ton of money to service providers and not get the same level of service. So what we as a firm are being asked, and we get inquiries, can you be a second auditor? For firms, for funds that are through the investment period and, don't necessarily look for a Big Four name, they're coming and talking to us, and we're winning those clients because they get significant more value for services that they get.
Yeah, well, I find that to be a huge differentiator at times. And well, listen, we're really appreciative of your time today, Sal. And I want to, one, thank you for joining us, and two, really thank you for your partnership with Convergence, and we're, delighted that you were able to join us and share your thoughts. And we wish you continued success. And again, a real pleasure to be with you today. So thank you.
Thank you, George. You've been a great partner. You've been a great guide, telling us what's going on in the marketplace. Thanks for all your reports that you send us.
I want to thank our guests. I'd like to finish with some comments on market growth and really kind of our league table roundup. So again, we're looking at the 12-month period from July 2020 to July 2021. In that time period, we saw advisors disclosed 99,398 private funds, so almost 100,000 private funds. That's an increase of almost 7%, and assets of over 24 trillion, which is a net increase of almost 14.7%. The top 25 administrators won 47% of those total new funds disclosed. All other administrators won 19%, while advisors who self-administered kept about 34% of those funds. On the asset side, the top 25 administrators won 54% of about 1.4 trillion in new fund assets. All other administrators won about 11%. Convergence continues to see very strong growth year over year on the PE and VC front. PE assets up almost 21%, venture capital assets up almost 50%. I want to make a couple quick comments just about asset growth and how that kind of plays out with the top administrators, in addition to, say, the 650 administrators. So when you think about assets over this last year, we saw assets grow about 14.7%. The top 5 administrators grew a little over 10%, so slightly below market. Administrators 6 to 10, though, grew at 19.5%, so almost 5% better than the market. Administrators 11 to 25, though, grew at 21%, so almost 50% better than the market. And all others grew very close to 20%. So we continue to see this trend month after month, that the high end is somewhat keeping pace with market growth, but once you get to administrators 6 to 10 and 11 to 25 and 25 on, these firms are in some cases doubling the market. So we are continuing to see advisors give more funds and assets to smaller fund administrators. And one of our future podcasts will start to talk about that question. On the audit front, we saw close to that same 100,000 private funds, a net increase of about 9,000 funds, which is about up 10%. Assets of almost 24 trillion, which is up also about 15%. The top 25 auditors won almost 70% of those new funds that came to market. All other auditors won about 6%. The top 25 auditors won close to 90% of new fund assets. And all other auditors only won about 1% of that. So very different story than what we're seeing in the admin market, where most of that audit business is going to the top 25. I'll give you a little sense of asset growth also for the audit market. So we see that asset growth at close to 15%. The big four keeping pace with that, right at that almost that same mark. But what's interesting is audit firms 5 to 10 growing at almost 26%, almost double the market. Audit firms 11 to 25 growing at 21%, 50% better than the market. So we're seeing some nice growth down market also with the audit firm, and particularly the assurance practices. But the difference here is we're certainly seeing the very high end keep pace with that growth. So I want to thank our guests for a great conversation this month. We really look forward to our clients joining us and talking about a variety of industry water cooler subjects. So thank you again to Jeremy and Sal, and I want to thank you all for listening, and we will see you in September. Thank you again.